Happy greetings, everyone. This is Ron William, dialing in from Switzerland, and today's webinar on Wednesday, the 29th of August, 2 p.m. GMT, is the true nature of trends, with a big emphasis on the word true. And it's just going to be an open discussion on some key themes. Just a note that if you want to follow up on any of my analysis soon to be launched in the next few weeks, you should be able to find it on www.ronwilliam.com, which is my new website. For any questions that you would like to ask, and please feel free to ask as many questions as possible. My email address is ronwilliampr@gmail.com. So that's ronwilliampr@gmail.com. You can also catch me on Twitter, LinkedIn, and in the near future, forexstreet.net, their very nice blog page. Okay, so that's just all the general contact information. Let's get started. So I always like to give a quick overview as to the areas that I have focused on all these years. I've officially been in the market for 13 or so years, working with various institutions. Probably one of the high peak points in my market experience was working at Bloomberg as a technical strategist specialist, where we basically traveled to the global client base, funds, banks, and hedge funds, to basically train on technical analysis, but also develop new strategies in the market. So it was quite an extensive experience, and that was also during the 2007 financial crisis. So I think during that time, it was quite an interesting time to be looking at different strategies and how they evolve. Over the years, it's been one strategy that I've really preferred to focus on, and then it's been market timing. What I mean by market timing is generally the use of cycles. That is very much what I look at on a daily, weekly, monthly basis. Various geometry patterns that can be derived between the relationship of price and time. I also look at, for my more trade setup type of techniques, I look for patterns such as Japanese candlestick trade setups, and then more advanced indicators such as DeMark indicators developed by Tom DeMark, which help highlight counter trend or turning point opportunities in the market. I also use this in combination with a number of my own proprietary strategies. But keep in mind that both my cycles analysis, which helps me understand kind of just the future ahead based on past patterns, and then the trade setups, Japanese candlesticks and DeMark indicators, all correlate in the one sense of identifying market timing. So it is really a primary focus on market timing, market timing, market timing. Now, just for some of you who would like to know, I am calling in from Switzerland, and this is a picture I took a few weeks ago during the summer weather that we have here. You can see this is a picture of somewhere in Switzerland where I like to give these webinars. It's a beautiful picture of one of the largest lakes in Switzerland and a small vineyard there that you can see. What I like to do now is ask, where in the world are you actually attending from? And this is a traditional question I like to ask. I'm just going to quickly switch on the chat so we just see where is everyone else from in the world. So where are you attending from? Where in the world are you coming from? And if you can let me know whether this is your first or if time to attend, or if you're a repeat attendee. So USA, Florida. Mike says Harley. Mike Chandler says Texas. Harley's a repeat. Thank you very much. Michael, not too far from you. German Alps, repeat visitor. Thank you very much from Germany. Keller from Poland, regular. Polinio from Italy, first time. Welcome from Italy. Carlos, cloudy Miami. Pip Yoda, London, England. Gam, Hampshire, England, repeat offender. Thank you very much. Mike Chandler, regular fan. Thank you very much, Mike, for your support. Gan from Toronto, Canada. Zetolos from Portugal. Edward from Warsaw. Anna from Poland. Paul Volker, I surfed Hurricane Isaac yesterday, so the Gulf. Emmanuel, London, UK, and Vorki from Africa. Okay, I'll stop there for a moment because just to keep in time, but it's fantastic to get so many repeat attendees. Thank you so much. And MIQ from Surrey, London. And to a lot of you that are here for the first time, welcome. I hope you enjoy the session. My sessions are branded as being very interactive and hopefully interesting to you. One of my quests is, what I would like to do is put out a challenge out there. If each of you could send in your global photos, so send an email photo to myself and ronwilliampr@gmail.com, a beautiful picture of where in the world you live or where in the world you're attending this webinar, just so I can see what you are seeing just as much as you are looking at my current residence. Okay, so that's just a quick question for some of you who would like to maybe share some of your pictures around the world. Feel free to do so and just email me on ronwilliampr@gmail.com a beautiful picture if possible, of where in the world you're from. It could also be the hurricanes or the tropical storms. That's also fine. I just took a picture of a tropical storm here in Switzerland, and that can be equally beautiful, Harley. Okay, so I'm now going to move with the rest of the session. So for the outline, three-part outline, the trend is your friend. I'm going to talk about that concept, the idea behind Newton's law of motion, and how successful trend followers such as Ed Seykota have made so much money on this successful strategy. Part two, we talk about, but what are the dangers of trend following? The key point, which I shared out with FX Street a while ago, the stronger the trend, the more violent the end. And then just a quick discussion about popular trends that ended: US dollar, gold, silver, and of course a lot of the manias, the tech bubble, 1987 crash, and of course most recently the financial crisis, which affected a lot of those risk trades. Part three, just a quick wrap up on the new volatility paradigm and how that affects trends. And then a question open to you: what are your experiences of trends that kind of didn't work out for you? And then I'm going to end on potential solutions. So that's basically it, part 1, 2, and 3. So here we go. I'm going to start now. So how do you feel about the trend being your friend? It's a famous phrase that if you trade in the direction of the primary trend, you're likely to be successful in making money. And so my question, I want to start off with the question, open it out to all of you here from around the world. How do you feel about this concept of the trend being your friend, trading within the direction of the primary trend? So I'm just going to open this up now. Can some of you please feel free to participate and just let me know, what do you think about this market mantra, the trend is your friend? So Harley says he agrees until it ends, of course, and that's an important disclaimer to add to that saying, the trend is your friend until it ends. Because the market has not been so trendy lately. That's a good point in terms of recent price activity. Anyone else? Fernando agrees with Harley. Zetalos agrees the trend is your friend. Gan says it's my friend when it begins. Mike Chandler says, oh, just one second. Mike Chandler says, market is neither friend nor foe, just opportunity prepared. Thank you so much for making that point. Very good point, Mike. Just think of positive and negative reactions in the market and how each of them can create an opportunity, absolutely. And so when people ask me, are you a trend follower or counter trend, I always say I do follow the opportunity, and market timing, in my opinion, allows you to do that. You can still follow the trend, but then with my market timing, know when that trend is about to end and then maybe make money on either side. Paul Volcker says trends occur only 20-30% of the time, so a friend if only 30% of the time. Good point, Paul Volcker. Interesting to see what some of you say about that. Gam is saying the trend can be a trap. Once it can be seen, people jump on it and can be taken out by this. Totally agree with you, Gam, and this is a key point I'm going to make here. The trend is generally your friend at the beginning, in the middle of the stage, but at the end, when it turns into more of a mania and more people are aware of what's going on, it can become very dangerous. And like I said, the stronger the trend, the more violent the end. And that is very much a counterintuitive secret that I'm sharing with you after some years of experience. Boyke says counter kills traders. True. Trying to pick the tops and the bottoms can be very lethal. And some people say trying to catch a falling knife can be quite dangerous. You get cut many times. Having said that, there are very famous market practitioners that do pick tops and bottoms in the market successfully, one of which is Tom DeMark, who's a very famous market timer. Borat is saying trend is subjective. There is no trend for me. Of course, you have to decide what type of trends, the primary, the secondary, the minor, so long-term, medium-term, short-term, and that really is important to know which cycle you are trading in. And then finally, the trend can be a trap. Sometimes it is an opportunity. Wish there was a reliable way of determining start and end of a trend. Okay, so fantastic contribution. Thank you very much. I hope FX Street was able to snapshot some of the really great sharing of information there. A lot of the points that you've mentioned, I'm going to cover, and I'm just glad that you've already mentioned it yourself, because it just shows that each of you are already thinking similar things. And as Borty said, it also does depend on the time frame. So all of these are valid points. So great points here. The trend is your friend. How do you feel? And each of you have very different and similar opinions here. I'm just going to stick to the simple points and switch on to one of the most successful strategists or traders of this current time, is Ed Seykota, who is interviewed in the famous Market Wizards book, an interview of all the top traders around the world by Jack Schwager. And Ed Seykota is famous for being a trend follower, so much so that he actually invented a song about trend following. And of course, he's famous mainly for having made so much money using trend following strategies. Now, one of the reasons why technicians for so many years have been trend followers is down to a lot of the invaluable works of Sir Isaac Newton, the famous physicist in several hundred years ago in the United Kingdom, that came up with the physical laws of motion, and of course many other things like the discovery of gravity and so on. And his first law of motion is what is so important to traders and technical analysts today. Every object continues in its state of rest or of uniform motion in a straight line. So things continue as they were previous, unless compelled to change. That is stated by external forces acted upon it. So there's a little bit of a long-winded sentence there. Every object continues in its state of rest or of uniform motion in a straight line, unless compelled to change. That is stated by external forces acted upon it. The buzzword there is straight line. So what has happened in the past can be extrapolated into the future, because motion tends to continue in that state of activity. If we are moving in a state of activity either up or down, a trend up or a trend down will continue within that direction based on Newton's first law of physics. But the second point is most important, unless compelled to change by external forces. So it's very important to monitor change, and change is the big word here. So a trend is your friend unless it changes and of course reverses in the opposite direction. So keep that in mind. A lot of us kind of take trends for granted, but it's very important to keep in mind that the most constant state of play in the market is change. And to be a successful trader in the market, we really must monitor change every single second, every minute, every hour, every day. Now, part two, we're going to talk about the dangers of trend following. And this is probably the main thesis behind my webinar here. And then, of course, the mantra that I'm teaching you, against popular opinion. The stronger the trend, the more violent the end. And I'm just going to discuss some points on US dollar, gold, and silver for part two. Now, the big danger with trends is human emotion. Human emotion is the biggest danger that we are likely to face when we trade trends. Now, I want you to think about that. This is a colorful collage of different types of emotions that we feel at any one time. You can see the big circles and the small circles, positive emotions, negative emotions, depressing emotions, excited emotions. We go through a whole cycle of emotions every single day that we trade. And that is down to the human emotion on a one-person basis, but also mass psychology around the world. All of us, millions of people around the world trading all together, and how we herd together emotionally and how that affects the trend. Now, human emotion it tends to believe in things in life happening all the time. And so one example is the sun rising every day. We know that the sun rises every morning and sets every evening. And so this is one of those universal accepted facts in nature. But having said that, what does this say for the market? When there are more buyers than sellers, then the market is deemed to be trending upwards. And you can see there a bull kind of roaring there in terms of the kind of bullish bias that we might see in market. More buyers than sellers, an uptrend. More sellers than buyers create a downtrend, and you can see there the bear scaring us there in kind of negative sentiment that can be perpetuated on the downside, and that's certainly what we've been experiencing since 2007. Now, the joke I'm going to share with each of you here, just because of what I've just mentioned, sun's rising in the morning and setting in the evening, and more buyers than sellers and more sellers than buyers, does not mean that trends last forever. And so here I'm going to invite you all to attend this new Walt Disney picture, Trends Forever. I recommend it for all of you fairy tale believers there, that we can make as much money in a very short space of time by trend following. Can obviously watch this movie, but I can tell you that there's a happy part of the movie, and there's another part of the movie, and the other part is the true nature of trends. That of course that they don't trend, they don't last forever. So just keep in mind there are no fairy tale stories out there of trends lasting forever. And should you wish to watch this movie, it's not available at the moment, and it's just my kind of humorous note. And so one of the points, the real points I want to make here is silver being a case in point, where we had lightning striking twice in 2011, and we had two crashes of about 30% in just 1 week, twice on the silver market. And I picked silver. I could have picked many other markets like the tech bubble of 1999, the financial crisis of 2007. But silver is a nice one because it brings into light a very popular trend. And you can see here what is good about this silver trade or the silver uptrend is it was just so accelerated to the upside, and there's such a parabolic move that you can imagine the amount of traders and investors that were leveraged up at those high levels around the $50 mark. Now, of course, silver also hit a historical high last seen in the 1980s, which you would need to look at your historical charts to actually see. And there are a whole variety of reasons as to why the silver market crashed from beneath $50. But just keep in mind the big psychological reason is that trend was just not meant to last forever. And it did suck in a lot of buyers, a lot of people that were making a lot of money. And so this becomes the issue. It's interesting that it did happen twice. And just keep that in mind. Can anyone suggest any other examples or popular trends that ended? I'm just going to say Carlos is saying commodities trader, I believe. Any other popular trends that didn't quite work out? So I mentioned silver. Does anyone have any other examples? Can be a short-term trend that maybe you traded the last few days or over the last few months. Any other popular trades that were very strong trends, but they just didn't last? Just going to keep this question open out for a moment or two. Okay, so some are saying that there's a few suggestions which are coming out. I'll recent markets, yeah, feel free. Recent markets, just to keep it topical. Gold's a great example. Gold is probably an even better example than silver, although silver outperformed gold. Gold's a great example, Julia, because I would say so many people were just following this wonderful safe haven trade that people believed was the great hedge against the end of the world. So whenever there's political or economic instability, buy gold. Now, of course, gold is still a very good safe haven trade, especially when keeping in mind a lot of the worthless fiat currencies out there in the world that governments are just printing aimlessly to try and get out of their debt situation in the US and Europe. But gold is governed by the same law that every other market is governed by, and that is any acceleration in the trend is unsustainable. And whenever this mass psychology becomes overcrowded, you will see a reversal. Now, Julie's also mentioned oil in 2008. Absolutely, there's a major crash there in oil. A great example is Apple. We had a big correction a while ago on Apple, but of course now we're seeing new highs. But Apple is a great example of a potential fantastic trend, which is likely to correct, just because trends don't last forever. Boyke's making the point that if you look at an intraday chart, maybe it's too noisy to identify. Paul Volcker's saying copper, absolutely. And then Anna's making a very good point on Facebook, when the bearish trend will end. Facebook, I mean, that trend tangibly reversed when it IPO'd. We had a kind of a several $100 billion IPO, historic IPO, which pretty much marked the top of the Nasdaq. In my opinion, served as a great contrarian signal for technology stocks. So we can keep in mind other big IPOs that happened in the past and how they highlighted hot money reaching an extreme and then potentially acting as a contrarian signal. And then Michael's making the point, yen carry trades, yeah, potentially reversing as well. And a nice humorous point there by Paul Volcker, Madonna, for any of you Madonna fans out there. Okay, so a lot of great examples there. Thanks, Anna, for some of your point, and Harley for your laughing. I'm laughing with you. So great participation there in terms of trends that did not last forever. Silver, gold, oil, Apple, potentially in the future, and then some of the other markets like copper, yen trades, and so on, and Madonna for some of you Madonna fans out there. Now, part 3, and this is the final part I'm going to end on. I just want to talk about the new volatility paradigm. What are your experiences of how volatility has impacted your trends, and then some potential solutions. Now, the new volatility paradigm is just based on the new normal that we keep on hearing being said on the television screens. And it's all about increased volatility. Now, this diagram here illustrates how volatility is described on a statistical chart. And here we have this probability distribution showing that this is a reflection of the reality of the market. The long tails of the distribution highlight highly extreme volatile times in the market. So think about all of these market shocks that we've seen on the markets that we discovered, that we spoke about, but also think about the mania crashes, technology crash, the 1987 crash, the 1929 crash, 1973-74, and of course most recently the financial crisis crash. A lot of these crashes, a lot of these market shocks on the long-term time frame are examples of these fat tails, these black swan events. And so just keep that in mind. These are the trend-ending environments that we experience. And of course, it can also be on the short-term time frame if you think about some of the other markets that we spoke about. So just keep in mind the new volatility paradigm. Now, I just want to quickly ask about what are your experiences in terms of when these trends end, what have you experienced when you've been applying your strategy? So just a quick question here. What are your, I'll follow up with Borty's question in a moment, but what are your experiences of trends ending? So how has this hit your P&L? How has this affected your strategies? If you can just give me a quick kind of information. How has trends that ended impacted your performance as a trader? Harley's saying just exit and look for something else. Very good point. So if you're in a trend that has ended, you don't have to stick with it. You can look for other potential trends. Think82 is saying I use MBX system that helps me predict trend ends. Very good point. So you are actually trying to identify the ends or the exhaustions of this trend. Gan saying when it bends, I bend with it, and wait until it comes out right. So that's a very good point. So you can buy a rising trend, but when it does turn to the downside, you can then maybe either raise your stop, use a trailing stop or risk management type strategy, and then maybe look to sell into that market and try and make money on the downside as well as the upside. Carlos is saying avoid temptation to be completely right. so I scale out of my position on occasion. Absolutely, very good point. Whether you're right or wrong, what is most important is to reduce the amount that you lose when you are wrong. And so the best way of doing that is using this idea of scaling your positions, pyramiding in or out, fading in or out of that trade. So you don't have to go in with a fully leveraged trade. You can just open up a small position, add to it as it starts to look more attractive. But of course, decrease that position when you start to feel that you need to be a bit more cautious. And so these are all very good points. And just keep in mind, there are other trends that you can look at if the trend that you're looking at isn't as good as it used to be. You can maybe try and buy into the rising trend and sell into a falling trend to try and make money on both sides of the market. But probably my favorite point here is whatever your strategy, trend following or not, I would highlight Carlos's point, avoid the temptation to be completely right. Making money is not about being right, and this is so important to keep in mind. And if you read the book of Jack Schwager, where he interviews the top traders around the world, he specifically makes the point that most of the successful $1 million traders around the world understand that 50% of the time they will be wrong about a market strategy. 50% of the time, at least, they will be wrong about a market strategy. And so what that means is the successful traders out there need to accept that they're going to be wrong at least half of the time. And that's a big psychological kind of barrier to actually accept, because it's very difficult for us to admit that we are wrong. And this is where our human emotion is our biggest enemy. And this is probably why I'm playing on this trend following idea, because the problem with trends is our own emotions. It's not the trends itself, it's the emotions that drive the trends, which is our problem. And keep in mind, as Harley said, these trends are all based on probabilities, so we really must kind of measure the probability of change, is what I would add to that. And change is the most constant dynamic in the market. And change is driven by human emotion. So it's just one big circle of human emotion, change, trends. Human emotion, trend, change, and so on. So keep in mind that the market is dynamic, but ultimately it's driven by human emotion, and that is what makes it our biggest enemy. Okay. Now here are some solutions I'm going to wrap up with. Of course, it's important to keep your classic analysis in mind, and this is a diagram I show on some of my webinars. Make sure you focus on the trend, the trend or the cycle you're in. Focus on key levels, that might suggest, key resistance, key support, or potential breakout zones where the market might reverse that trend. Use indicators to maybe spot extreme moves like climactic moves, overbought, oversold indicators, or divergences, so where the market is doing one thing but the indicator is telling you the opposite, and gives you a little bit more internal information. Now, one point I want to make here is, you can also look at, the last webinar, which was getting very good webinar on sentiment indicators. You can use sentiment indicators as well as momentum indicators to suggest that change in price activity versus the internals in the market. I always say momentum, volatility, and liquidity. And so one of my measures of liquidity is CFTC for the FX market. Momentum, of course, you have your RSI, stochastics, MACD, and volatility, maybe Bollinger Bands and various other indicators. But just keep in mind, trends, know which trend you're in, and make sure you understand how that trend changes. Key levels can tell us something about areas in the market which are starting to have pressure build up and might trigger a breakout. And indicators, of course, can allow us to understand the internal dynamics of the market using momentum, volatility, and liquidity groups of indicators. Now, the most important point out of those 3 points, cycles, levels, indicators, is actually cycles. And this is part of the point that one of you made actually at the beginning, that one of the key ways to understand when that trend is going to continue and when that trend is going to end is to actually understand which cycle you're in the first place. Is it the primary cycle? Is it the secondary cycle? Is it the tertiary cycle? To quote Charles Dow, key tenets in the traditional technical analysis books. Long-term, medium-term, short-term, whatever your time frame might be, intraday, daily, weekly, understand what your cycle is. Because, of course, within that, within the 2 or 3 cycles that you're looking at, your intraday, daily, and weekly charts, you do need to kind of watch out for potential correction points. Last point I'll make is perception versus reality. I made this in the last webinar. Our human emotions sometimes get ahead of us, and sometimes, like this young kitten here looking into the mirror, a young kitten with a very courageous lion kind of feeling. How many of you have felt this way in the past about a particular trade? Try not to fall into the trap of wanting to be right, and so not getting out that trade because you just believe that you're right and that the market is wrong. The market is not right or wrong. You just have to follow the market change. And then lastly, I just want to end off on exit strategies. Control your risk, whether you're right or wrong. Remember what I said, it's important to manage your risk as best as possible. And if you accept the fact that you will get things wrong at least half of the time, as all the top successful traders out there, then keep in mind that you need to focus on your exit strategy. You need to know how to control your risk. And so use your technical stops, beware of round numbers, because a lot of other people are watching these numbers in the market. It's psychological numbers or highs and lows in the market. Financial stops, try and use something that makes sense to your money management, how much money you actually have in the account, so that you can have enough trade opportunities out there. So if you see a trend that isn't working out for you, you can then trade another market with a better trend. Volatility stops, this is a big favorite of mine. I like to use stops which actually take in volatility, like average true range or stop and reverse trailing stops, like parabolic. And then finally, break-even stops. Whenever you do make money, one of my preferences is to try and break even. So raise your stop to your entry point so that you can ensure a risk-free trade. And then, of course, once you do that, you can then trail that stop and lock in profits. So I've gone pretty quickly through the session. I'm just going to see if we have any. We have some time left, which is good. But what I want to do is just check for any questions. I can review some of this presentation if you want. Borgi's saying if you can talk about key levels. Harley's asking, will there be a third webinar on Fibonacci? I'll work on that. My apologies for that. There was supposed to be another Fibonacci webinar because the previous one cut too short, so I will work on that. But let me speak with the FX Street team and try and outline a time. Mike Chandler is saying, Ron, can you do a webinar sometime on time analysis versus price only? Sure. So maybe an advanced cycle analysis. I'll keep that in mind, Mike. Certainly something I would enjoy doing. Any other questions? So right now we have a few moments to take questions. Borky, absolutely. I'll keep in mind the part 3 for Fibonacci. Any questions on what we've spoken about so far? I've finished in time, so I can just go over some of the material again. Any other questions? So on what we've covered, let me, key levels. Okay, what would you like to know about key levels, Borky? So different ways of using key levels. Let me go back. Okay, what are key levels? Okay, very good point. What I'll do is I'll type in a few points into the chat. What I would say key levels are highs, lows, resist, support, okay, so this is what I mean by key levels. I actually covered this area in a previous seminar that I gave, but I'll quickly kind of say it now. Highs, lows. So basically the market high, the market low. But when I say highs, lows, I also mean extreme highs and extreme lows, because these are very important to the market. Keep in mind that the market has a memory. And so a lot of the time people kind of say, okay, this is a key level, but how important is that key level to the market participant? So you have to really remember that the market has a memory. So you need to know, well, how many people are going to remember that key high, that key low? So for example, the S&P 500 is at a new 2012 high, but that high was last seen in 2007 and 8. So just before the Lehman debacle is where the market is at the moment in price terms. And so that is a very important price level in the market. So that's an example of a high and a low, but I'm picking like a very important event risk high like the Lehman debacle, which is where the market is. And so because the S&P 500, because the S&P 500 does have a price memory, there's going to be a lot of pressure in the market, in my opinion, on the current price activity that we're seeing on the S&P 500 and other Western equity markets. I also would say resistance support. So, whenever a market hits 3 swing points in the market, 3 is your magic number because that then increases the probability of that level holding or being significant. Psychological number, think of your round numbers, as Boki just said. Psychological numbers, I also mean round numbers. That can be like $100 on oil. The oil market, if you look at West Texas contract, is about to hit the $100 mark. $2,000 on gold. That was a lot of people believe that gold was going to break above $2,000 last year and this year, and it hasn't happened yet. So that created a big psychological barrier, a round number phobia area. And then lastly, Fibonacci. Fibonacci, of course, is a session in itself. You can look into the FX Street archive on a session I gave on Fibonacci a few months ago. But Fibonacci are very important geometric numbers, ratios that we can find within the market based on a mathematical sequence, which of course all of you probably know and use already. Any other questions? So key levels is one that I answered. Does anyone have a? I want to kind of quickly focus on the point of, just one second, technical on stops. Can anyone tell me what they think about what type of stops they use? So just before we wrap up the session, the kind of stops that you use, what works for each of you? Because I think this is the most important thing, the exit strategies that you use in each of your trades. Any suggestions? So Gan is saying technical stop, Harley's saying manual stops, Borky's saying first time, all the time, trailing stops, stop based on volatility below the last swing. The good thing is that each of you have a definitive answer of where you put your stops. And I'm going to ask a devil's advocate question. How many of you change your stops more than you would like to? How many of you change your stops more than you would like to? Okay, so we've got one very honest answer there. Julia's saying never. Tina's saying trading stop, so based on risk reward. Good point. You need to know how much you're going to make before, how much you're going to lose and how much you're going to make. Look at technicals and volatility together. Harley's saying it's my money. Very good point. And then we have a very big answer here from Carlos. When analyzing trend reversals of particular markets such as gold, silver, dollar, and oil, do you believe they all reflect conditions which change of market affect? Do you believe that they all reflect the conditions and change of? I think I understand what you're saying. If you could kind of try and clarify that again. But my understanding is, are you saying that each of these markets are similar? Every market has a different characteristic. That's one thing. And a lot of these characteristics between markets are differentiated by the level of volatility that exists in those markets. And so just as each of us around the world have different faces as individual people, so does the market. But the way that we can see the difference of faces in the market is by the volatility signature, the level of volatility. So I would say the more volatile the market, the more risk you will be taking on when you trade it, and the more probability that trend is going to be unsustainable. Increased volatility helps the trend during the early and the mid stages, but it leads to a major reversal at the ending stage. So keep in mind, the very volatile market can have very violent trend endings. And so, that can be the equity market if you look at some of the stock market crashes, which have been famous over the years. Also, commodities, to be fair, can also have very strong spikes to the upside due to the way that commodity markets are traded. Keep in mind that the emotions that drive markets also differ. So, for example, the stock market is generally led by greed on the upside and fear on the downside, whereas commodities sometimes actually is driven by fear on the upside. and then an even worse emotion on the downside. But what I'm trying to say is sometimes markets like gold, gold can have a massive spike because people are fearful of what's happening around in the world, so they pile in on gold. Oil can spike up because of geopolitical risks in the Middle East, for example, and so people are fearful of geopolitical risks, and so they start piling into oil. So keep in mind that that there are differences. Volatility is the key difference, and stock markets can generally be led by manias, and that's what leads to crashes. But then you have commodities which can be led by event risk, such as political, economic instability, which we can see on gold or oil spiking higher. I hope some of what I'm saying is clear. Chuck is saying rarely stops are your friend. Yeah, that's a good point. I mean, there's another phrase that you should let your profits run and cut your losses quickly. That's another phrase which I could have included here, but we have only a few minutes left. Keep in mind that your profits. Let me write that in. Let your profits run and then cut your losses quickly is the traditional phrase, but keep in mind that sometimes the market volatility will take away your profits. So a lot of the time you do need to really kind of lock in some of those profits as that trend develops. And so that point about stop losses not being your friend, sometimes it is your friend because at least it guarantees that you only lose a certain amount. It's really important to focus on risk first and then reward last, not the other way around. As Harley just said, stops can protect you from extreme money loss, and that is probably the most important point here. Since 2007, more people in the market are concerned about conserving their money, not trying to get rich quick. A lot of people want to conserve their money. And if you look at the top funds out there that are managing money, or the top traders out there that are performing, consistency is now what is so important to everyone. Not I made $1 million in one day, but I was consistently profitable over the last 12 months. People are looking for conservative, consistent profit performance, and obviously managing risk. Mike makes the point, does event risk, up-and-coming Jackson Hole, influence whether or not you take new trades? Personally, yes, I do take into mind event risk, but I try not to let the event risk dictate my trade. What I'll do is I'll look at the market price action first, and then if I'm aware of certain event risk, I'll look at that market chart and ask myself the question, what is a 1 or 2, 3 standard deviation move on this chart? Just in case that event risk were to, a market breakout were to magnify that event risk, or the other way around, the event risk leads to the market breakout, what would it look at in price terms? So it's really important to not get carried away by the fundamentals of the event risk, but to keep in mind the market risk. I hope that makes sense, that question there on event risk. So yes is my answer, Michael, but the way I look at it is I focus more on price first and then event risk second, and I look at standard deviation to try and quantify what that risk might be on a price basis. But I don't trade on event risk. There are people that I know, many who trade successfully on event risk. Zetolos is asking, that's the key, protect our money, stop loss. Think82 is saying at the moment, I'm increasing some trades more than 20% on dollar CAD because I strongly believe it will turn bullish sooner or later on. Okay, so that's an interesting idea. I can talk more about market specifics in the next webinar, which will be more focused on strategies that I am following at the moment. Okay, so what I'm going to do is just talk about the next webinar, just so you know what to keep in mind. Just keep in mind what we've covered today. Today, if I just go to, just want to quickly show you what we've covered today in terms of the summary. Okay, so we've covered part 1, the trend is your friend, Newton's law of motion. Part 2, but what are the dangers? Keep in mind the stronger the trend, the more violent the end. We've spoken about popular trends that have ended, like gold, silver, but also oil, Facebook, Apple potentially in the future. Part 3, the new volatility paradigm, what that means for the trends, but also for your trade performance. What are your experiences? A lot of you have kind of spoken about using trailing stop strategies and different types of ways of minimizing risk. And then I've spoken about potential solutions, and that's pretty much focusing on the cycle that you're in. We spoke about key levels there, and then also perception versus reality, not letting your emotions getting the better of you. And remember, one of the biggest dangers of trend following is human emotion, not believing that what happened yesterday is going to continue forever. Remember that that is a fairy tale movie, which doesn't exist and can obviously get you into a lot of trouble. Last point I made, and I'll repeat this again, exit strategies are so important. Whether you're right or wrong does not matter. The most successful traders in the world accept that they will get it wrong at least 50% of the time. And so in getting it wrong, you have to minimize how much you get it wrong by in terms of how much money you lose. So keep in mind, control your risk. Exit strategies, use your technical stops, financial stops, volatility stops, and break-even stops. With break-even stops, make sure you lock in profits once you actually reach a break-even point. Okay, if you have any points, please email me on ronwilliampr@gmail.com. Remember my request to send in any beautiful photos of the countries that you are living in from around the world. The next webinar will be Market Outlook for the fourth quarter 2012, what my views are, and that is on Tuesday, the 11th of September at 2 p.m. GMT. If you would like to follow up some of my analysis, which will start to be launched in September, you will find that on www.ronwilliam.com, which is my newly launched website. And please feel free to sign up to my Twitter or LinkedIn. Twitter is RonWilliam7, and LinkedIn is Ron William, just type in my first and last name. And of course, forexstreet.net for some up-and-coming blogs. Thank you very much, everyone. It's been an honor and a pleasure, as always, participating in this webinar. Thank you so much for all of you new and repeat attendees from around the world. Really appreciate your support. This is Ron William, technical strategist, trader, and educator from Switzerland, signing out. Thank you very much, and I hope to see you on Tuesday, 11 September at 2 p.m. GMT, Market Outlook for the fourth quarter of 2012. This marks the end of our educational webinars for the summer, and I look forward to our market strategy focus on the 11th of September. Thank you very much. Bye-bye.